Hey guys, what's going on? Welcome back to Stocks with Surfing. So today we're going to be breaking down a company that has essentially become the heartbeat of the entire global economy. It's a compounding machine that I believe is going to stay dominant for decades. That company is Nvidia. Look, Nvidia has evolved from just a chip company into the world's most profitable infrastructure powerhouse. They've built a massive flywheel across data centers, gaming, and robotics that competitors are literally breaking their budget trying to match. At this point, they aren't just selling hardware. They are the global gatekeepers of the AI revolution. But even with record revenue hitting the books, the stock has been taking a hit lately. Is this a dip that you should be buying, or is the engine finally cooling off? Today, we're looking at the Powerwall, the recent Supermicro scandal, and the actual fundamentals to see if the math still adds up. Stick around until the end because I'm going to reveal my exact price target based on these numbers. So now we're going to talk about why the stock is down. First, we have to look at the Powerwall. So we've hit a structural tipping point in March 2026 where the primary scaling constraints for AI has shifted from silicon to electricity. Nvidia is shipping the new Vera Rubin NVL72 racks at record speed. But these systems are incredibly power dense, and a single rack can pull over 120 kilowatts. And we're seeing hyperscalers like Microsoft and Google struggle to find the grid capacity to actually deploy them. The reality is that data centers can be built in 18 months, but upgrading the high voltage transmission lines to power them can take 3 to 7 years. This mismatch is creating an interconnection queue. That is literally blocking a third planned data center projects this year. Investors are pricing in a temporary ceiling on revenue growth, not because the demand for Blackwell or Rubin chips has slowed down, but because the physical infrastructure of the grid can simply not keep pace. So what's the point in buying more chips when you're not going to have that power to plug them in? The second year, we have the Supermicro problem. So for this drop is the Supermicro scandal. This past week, federal prosecutors unsealed a major indictment against a co-founder and several individuals at Supermicro Computer. The DOJ alleges a massive $2.5 billion smuggling ring that used dummy servers and falsified documents to divert high-end Nvidia-powered systems into China, bypassing strict U.S. export controls. While Nvidia is not named as a defendant, this creates a massive compliance overhang for the entire sector. Supermicro is one of Nvidia's largest integration partners. If the Department of Commerce decides to tighten the screws on export licenses, or if Nvidia is forced to distance itself to protect its own regulatory standing, it could disrupt a significant portion of the server supply chain. The market is reacting to this risk. That is, this federal investigation could lead to broader oversight that slows down global shipments of AI hardware. Now, let's look at the actual revenue growth behind Nvidia because, man, it is absolutely staggering. Now, let's take a look at the revenue growth by segment just so we can see how fast Nvidia truly is growing. First, let's start with data centers. This is the engine driving the entire company. We're talking about high-performance GPUs like Blackwell and the new Vera Rubin architecture that power everything from ChatGPT and Google's Gemini to massive national AI projects. We're currently witnessing a historic shift from general computing to accelerated computing. Companies aren't just buying chips anymore. They're building massive AI factories to process the world's data. The speed here is staggering. Data centers now account for 91% of Nvidia's total revenue. At this point, it isn't just a business segment, it is basically the company. Every other division is effectively a specialized branch of this core AI powerhouse. Next up, we have gaming. While AI gets all the headlines, the classic GeForce RTX business remains growing. The recent launch of RTX 50 series gave this segment a massive 41% boost, proving that the consumer market is still hungry for high-end silicon. It also acts as the ultimate testing ground for AI features like DLSS4, which uses neural networks to generate entire frames in real time. For investors, gaming provides a steady multi-billion-dollar cash floor. It generates high-margin capital that helps fund the massive R&D budget required for their data center breakthroughs. It's the reliable foundation that allows Nvidia to take bigger risks elsewhere. Next, we have professional visualization, the industrial metaverse. This is AI for the physical world. This segment uses specialized chips and Omniverse platforms to allow architects and engineers to build digital twins. We're seeing companies like BMW and Siemens simulate entire factories in high-fidelity 3D before a single brick is laid in the real world. Last year, this segment saw a massive 70% jump because industrial AI is finally moving out of the lab and into the mainstream. It's no longer about just looking at a 3D model, it's about running physics-accurate simulations to optimize global manufacturing. The final segment we have here is auto and robotics. So finally, we have the future brain, powered by the Nvidia Thor platform. This is the central nervous system for the next generation of self-driving cars and humanoid robots. As companies scale up full self-driving capabilities, they need massive onboard compute, and Nvidia is the go-to provider. They're also powering the next wave of robotics through their Isaac platform. While this is a smaller segment today, at roughly $2.3 billion, Jensen Huang's long-term thesis is that everything that moves will eventually be autonomous. Effie's right, this is a $100 billion market just simply waiting to happen. And while that is how Nvidia got to $215.9 billion in revenue for fiscal year 2026. And well, it only goes up from there. Now let's take a look at the fundamentals of Nvidia, starting with the net profit margin at 55.6%. Now this is the king of stats. For every dollar of revenue Nvidia keeps, 56 cents after all expenses and taxes. To put that in perspective, the average profitable company in the S&P 500 keeps about 10 to 12 cents. Nvidia is essentially operating with the efficiency of a software company while selling physical goods. Next, we have return on equity at 104.4%. This measures how much profit the company generates with the money shareholders have invested. An ROE over 100% is astronomical. It means that in a single year, the company generated more profit than the entire value of its net assets. It shows the management is incredibly efficient at recycling capital. Next, we have a debt to equity at 0.05. This is the sleep well at night stat. It means for every $1 of equity, Nvidia has only 5 cents of debt. In a high interest rate environment, Nvidia is completely immune basically to debt traps because they don't need to borrow any money to grow. They fund everything with their own cash. Now you have the free cash flow at $96.7 billion. This is the actual cold hard cash left in the bank after they've paid everything, including new factories and R&D. $96 billion is enough to buy almost any other company on the planet and still have a change left over. Next, the ratio of 3.91. This measures the short-term liquidity. With a ratio near 4, Nvidia has $4 in cash or short-term assets for every dollar they owe in the next 12 months. They're functionally uncrashable in the short term. Now let's take a look at some of the valuation metrics here for Nvidia. So let's start with the trailing PE. This is the price you pay for every dollar of last year's profits. Well, 36x sounds high compared to a grocery store that would usually sit around 15x. It is actually very low for Nvidia historically. It suggests the stock price hasn't kept up with how fast the profits actually grew. And if you take a look at the chart on screen here, you can see that last year at this time, March 2025, the trailing PE ratio is actually 46.2, so it has come down significantly. Next, let's look at the forward PE ratio. So this is the most important valuation stat here, sort of. It's the price you pay for every dollar of next year's expected profit. At 20.8x, Nvidia is currently cheaper than many slow-growth consumer companies like Coca-Cola or Costco, despite growing 10 times faster. As you can see, last year was sitting at 28.5x, and now it's at just 20.8. Now let's take a look at the PEG ratio that's currently sitting at 0.55. So this is the price to earnings to growth ratio. It's the ultimate deal finder. Any number below 1 is generally considered undervalued. At 0.55, it means that you're paying a very small premium for a massive amount of growth. This is the stat that most Nvidia bulls used to argue that the stock right now is a bargain. Then we have price to sales, currently sitting at 19.9x. This is the hype check. It shows you're paying $20 for every $1 of revenue the company brings in. This is the one stat that bears point to as being expensive, but it's high because their profit margins are so huge. You aren't just buying sales, you're buying high profit sales. So those are going to trade at a premium. But as you can see, even still compared to last year, it is down slightly. So I'll be the first to admit that valuing a company in the middle of a generational AI shift is incredibly difficult. We're balancing massive infrastructure demand against equally massive capex spending. But when you strip away the noise, 2 data points stand out to me. first, let's look at the price relative to the rest of the market. Right now, Nvidia is trading at a forward PE of roughly 21x. For context, the average stock in the S&P 500 tech sector is sitting around 23x to 24x. When the clear leader of the AI revolution is trading at a discount to the average index fund, that represents a massive fundamental disconnect to me. On the growth side, we're looking at a PEG ratio of 0.55. Usually a PEG of 1 is considered fair value. For a growth stock at 0.55, the market is essentially pricing Nvidia as if its growth is about to fall off a cliff, even though demand for Blackwell and Rubin chips is projected to stay strong through 2027. To find the actual safety net, I ran a discounted cash flow bear case. This model assumes the AI boom slows down significantly and margins start to compress. Even in that pessimistic scenario, the fundamental intrinsic value or safety floor, it calculates out to be $128.60. The bottom line, with the stock currently trading at $172, I feel like we're much closer to that absolute disaster floor than we are to the highs we saw last year. Well, I'm not going to give a specific price target because the market is too volatile for a crystal ball right now. It could go down 2%, 3%. It could go up 20%, you know? The math tells me we're paying 2024 prices for potential 2027's revenue. Before we wrap up, a quick reminder, I am not a financial advisor. This video is for educational and entertainment purposes only. Investing in individual stocks like Nvidia involves high risk, and you should always do your own due diligence and consult with a professional before making any trades. To me, this isn't about chasing hype. It's about the fact that the business's fundamentals finally look a lot bigger than the stock price. But what do you think? Is the AI floor at 128 realistic, or is this more room to drop? Let me know in the comments below. Now, I do want to end this video saying that I am personally not buying right now because I don't have enough money in my book portfolio to. But if Nvidia continues to drop and it is still discounted to the rest of the market while signs are pointing to, increasing growth, then I will definitely look to invest. But one last thing I'm going to look for is I want to see continued CapEx spend by the big tech companies. I'm a little bit concerned due to analysts' pressure that might fall off. And if that falls off, to me, that is going to be a sign that Nvidia is going into some headwinds. So I'll see you guys later. Take it easy. Peace.